Hi everyone and welcome back to Beyond Alpha. Today we are tackling a question that has been debated for decades. Is acquiring a real estate truly an investment? We are breaking down whether buying or renting a house is more convenient and why stock investment may be a better option for some. Now, if you are ready to equip yourself with critical knowledge, subscribe to the channel and let's get it started. First up, let's start exploring real estate as an investment. Real estate is often seen as a medium long-term investment, meaning you're looking to a commitment of at least 5 to 10 years. This extended period means also that your capital is tied up, making it less liquid compared to other investment options. And this can be seen as one of the main shortcomings for real estate investors. Moving on. To thrive in real estate, you need to be proactive. Study the market trends, identify up-and-coming areas with high demand, and ultimately be prepared to make bold decisions. Because it is not just about buying a random property. It's all about understanding where the market is heading. Think of Robert Kiyosaki, who built his wealth through savvy real estate investments. With the right strategy, you can follow his footsteps and become the next real estate mogul. Now let's delve into the returns on real estate versus stock investing. This is where things get really interesting, so stay with me. We will examine this through 3 key milestones: time horizon, expected return, and opportunity cost. First up, the time horizon. We already mentioned real estate investments require long-term commitment. You are locking in your capital for 10 years or even more, but don't get me wrong, this can be also advantageous if property values are rising, and this is crystal clear. On the flip side, it also means that your capital is less accessible if you need it. Number 2, the expected return. To explain this point, I would like you to follow me on this quick example. Suppose you buy a property worth $200,000 and it appreciates by 50% over 10 years, meaning that you are looking at a gain of $100,000 gross. However, remember that real estate investments come with ancillary costs, such as property taxes, maintenance, utilities, and so on. And this can eat into your profits, making the net gains lower than initially seems, and this is not good at all. Now let's compare this with an investment in the stock market over the same time span. If you put that $200,000 in an index fund based on the S&P 500, for instance, which has historically returned about 10% per year, you can already imagine that your investment will grow significantly over time. More precisely, thanks to the compound interest effect, over 10 years, with a 10% return, you could expect gains of around $320,000. So, long story short, 3 times as much as the real estate investment. But this is not yet over. Even if you adjust the annual return to 5% from 10%, so we cut it by 50% to match it with the real estate scenario, you will still end up with $126,000 in gains. And this is all due to the power of compounding. That is the power of generating interest on your interest, dramatically boosting your returns over time. To be comprehensive, I enclose a quick Excel model in the description down below to check whether it is more convenient to buy real estate or stocks, factoring in your personal circumstances, such as the effects of potential rents collected or to be paid, on top of the expected rate of return and the duration of your investment. I'm sure you will make some nice discovery playing with it, so have fun. Moving on, the big question at this point is the following: why do stocks often outperform real estate investments? To me, the reason is pretty simple. Stocks represent ownership in businesses that generate ongoing profits. Real estate, on the other hand, just rely on market appreciation for returns. And this is pretty obvious because if you don't rent out the property, it doesn't generate any cash flow, which can make it less appealing compared to stocks that in the first place can provide regular dividends on top of benefiting from capital appreciation over time. Third point, the opportunity cost. It is the profit you forgo by choosing one investment over another. As we said, without rental income, real estate investment does not provide any immediate cash flow. You are also dealing with ancillary costs such as taxes, maintenance costs and utilities. Plus, you have to consider that your investment will be highly concentrated unless you buy multiple properties, that in any case we can cluster within the very same asset class. This to say what? The stocks also offer the possibility to diversify your investment across multiple industries, and diversification can help managing the risk. Buying and selling shares quickly, giving you faster access to your money. Now, with this information, we can answer the question whether it is better to buy our primary residence or rent it out. Well, it all goes back to the concepts of opportunity cost and risk tolerance. More precisely, if you identify potential alternatives that can provide you with higher profits, you should not crystallize your liquidity into one single investment, especially for a long time period. Rather, you should invest in the most lucrative option to pay a potential rent and reinvest the excess capital, generating a positive loop. Anyway, we have also to consider that this proactive behavior does not fit with the risk attitude of most of the people. Reason why each and every investment should be calibrated on top of the earning generation potential, also on our personal risk tolerance, because we don't want to be overwhelmed by our investment decision, but it's advisable to face our investment choices with a positive attitude and rationality, and this is important. Moving on. Additionally, let's touch on taxes. The tax treatment of real estate can vary significantly by country. For instance, in the US, the 1031 exchange allows you to defer taxes when selling investment properties, if you trade it in for another real estate investment. Be aware that in any case, you do not avoid the tax payment, you just postpone it. And just to make another example for those one aiming to buy property in Italy, there you can benefit from lower VAT taxes on primary residences, but if you sell before 5 years, you will face penalties. And the amounts of these penalties are pretty expensive. Also, let's not overlook financing. Large real estate investments often require borrowing, which means paying interest that can significantly reduce your returns. This is another crucial factor to consider when evaluating any investment option. To sum it up, deciding between real estate and stocks hinges on three main factors: time horizon, expected returns, and opportunity cost. If you have limited capital or don't plan to rent out the property, we can ultimately say that stocks offer higher flexibility and higher potential returns. Of course, we have to factor in that stocks may be also more volatile and subject to market swings. So guys, here you have it, a quick comparison between real estate and stock investing, giving you some critical factors to consider what is the best investment according to your own preferences. If you find this video helpful, don't forget to smash that like button, subscribe and hit the notification bell so you are always updated with the latest contents from Beyond Alpha. Share your comments down below and let me know what is your preferred choice between real estate investments or stock investing. Until next time, keep exploring and investing wisely. Cheers!